Hi, welcome to the podcast. My name is Cindy. Professor Moyer was my professor for PVC and fixed income class. I learned so much from your class, and I thought it would be great to share with a broader audience. So thank you so much for being here.
Oh, it's my pleasure. Quite an honor to be asked.
Yeah, and I also invited my friend Arman to co-host a podcast with me. So I guess we can start off with early education background. You went to Grinnell College for undergrad, and then you did a JD MBA at Stanford and Chicago. You started practicing law, but then pivoted to finance. So I guess what about this industry that attracted you?
Well, I mean, it was kind of funny. When I came out of Grinnell, I thought I wanted to be a lawyer. And then I got to law school, and that was kind of the first time anybody started talking about, you know, investment banking. And it just seemed like, if you weren't an investment banker, you were an abject failure in life. That was kind of now, particularly when I got to Chicago, that was kind of the ethos that was going on. And so I got the impression, well, it kind of sounds interesting. It kind of sounds like you can make a lot of money. That was doing it, and I really liked the law, and so I got out and practiced for 3 years total. Had a great learning curve. I mean, I was doing stuff that I had no background to be doing. They gave me so much responsibility that was great. But a practical reality of law is that, you know, you can be in your chair and going ahead and I was doing primarily a securities practice. They're doing securities law, and you work your tail off for 7 years. And the whole thing is about making partner at the law firm. That's when the big bucks come. And the reality is that when that class with 7 years of experience comes up for partnership, and so that's considered a partnership class, they only take a certain number of them and make them partners. And lots of times being the best lawyer is not the criteria. It is, what do they need? If we are in an environment where, we're in a recession and there's a lot of bankruptcy, and I'm an IPO securities lawyer and nobody's doing IPOs, but there's another lawyer who does bankruptcy, they get the nod for partnership. And even though I was a really, really good lawyer, I have to go out and find another job. Or sometimes you can change status. But I just didn't like the fact that I couldn't control my destiny. And there was also the reality that within law, it's gotten a little better now, but you could work a lot harder and provide a lot more value to your firm, and you got paid pretty much the same as the person in the next office to you. And I didn't like that either. I wanted more of a meritocracy where you got compensated for your contribution. And that happens in investment banking. So it was the interest, it was just kind of the monetary rewards. That's kind of what made me interested in making the switch.
Got it. That makes a lot of sense. Well, I guess we're both starting in banking.
Yeah. And I guess a quick follow-up is you did your JD MBA at Stanford and Chicago through their dual program. What was that experience like in pairing your JD with the MBA?
Well, first, it's not exactly an established dual program. It's not like doing it at one school. So I was, I'll be very candid. I wanted to do the program at Stanford, not surprisingly. I was coming out without any work experience straight out of Grinnell. I just didn't get into Stanford Business School. And so I had thought about Plan B, and at the time, the University of Chicago did not require as much work experience. And so I managed to get myself admitted at Chicago. Started at Stanford hoping I could get in, but I didn't. And I went to the dean of Stanford Law School and basically said, who happened to be my property instructor at the time, and said, well, would you be willing to write me a letter of recommendation to transfer to Chicago? And, he said, sure, but why would I possibly want to go to Chicago when I was at Stanford? And I explained the deal, and he said, well, do you have a way of staying here and doing your degree there? And I said, yes, if you'll grant me credit for University of Chicago coursework, I can make the deal work between the two in the same time frame. And so he let me do that, and that's how I kind of created that deal. It's kind of a one-off. It was wonderful from my perspective because you got to see two very different institutions. I mean, Stanford and Chicago are really, really different places. Chicago was, pretty special place to do B school because of all the Nobel laureates that were around there. We were in the same building with a lot of the Nobel economists, et cetera, that was there. And so kind of just seeing the two different cultures was very interesting.
And which one do you like more?
Oh,
Sounds like
Stanford.
Chicago.
Stanford for sure.
Okay.
Stanford for sure.
Got it. Okay. Moving on to career, you moved to first Boston and then Drexel 3 years before the Valentine's Day massacre occurred to this high-performing firm. What was it like for you working on the high yield research desk at Drexel?
Well, Drexel was a very intoxicating place to work. There was an esprit de corps at Drexel where they just felt they could get any financing done. Any financing done. And so when they looked at deals, Mike Milken was a genius and he could always figure out a way to get it done. And he was a compelling enough salesperson, he could figure out how to sell it to any of his institutional clients
Okay.
that was out there. And so, yeah, Drexel was a great place to work. It was a hard culture in terms of the work ethic and what was demanded of you. But within the research group, on the trading desk, and our research group was, on an X right next to the high yield trading X. And of course, that's the way Drexel was organized. And that was, again, just intoxicating to think about everything that was happening on that trading desk and overhearing the phone calls that was happening. And the guy who ran research, Joe Benzavega, was a terrific guy to work with, et cetera. So I just had a great time. But it was, shocking, shall we say, when we walked into the office. And I believe that, like this year, I believe February 14th fell on a Friday that year. And they just marched us down into the biggest conference room and said, "You're fired. Drexel's going down. You're fired." And that was it. Short conversation.
How did you feel that Friday?
Nervous. I had gone to Drexel to do something called asset securitization. And then, long story, but I ended up being asked to join the high yield research group. And if you were at Drexel, you kind of wanted to be involved in the high yield bonus pool because that was the biggest bonus pool at Drexel. So that wasn't a hard conversation to get me to move over there. But I had not been a research analyst for very long when this happened. And so I kind of worried about my employability. I kind of wanted to stay in high yield. I could have gone back to asset securitization, but once I got to the other side, I kind of wanted to see that through. But it turned out, frankly, anybody with Drexel on their resume in high yield at that time had lots of different job opportunities.
And following up, just the alumni from Drexel went on to found extremely established firms like Ares, Apollo, Moelis. What about Drexel?
Yeah.
What about Drexel and that group made it so that the alumni after Drexel became these entrepreneurs that took over finance in the industry?
It might go back to that esprit de corps. There was nothing that we didn't think we could get done. And I think all those guys came out and said, well, of course I can start my own fund or my own investment bank and make it work. It was just kind of the ethos of the place.
Makes sense. And then moving on, you published Distressed Debt Analysis in 2004. It was actually recommended by my USC mentor, Chandler, and the first restructuring book I've ever read. And also, at the same time, you're working at Imperial Capital. So what made you to write the book?
Well, frankly, I always thought that I wanted to teach as the last aspect of my career. And so I like to write. I was a reasonably good writer, I think. I think a lot of people might have said, well, I know a lot of stuff, but I really hate writing, so I'm not going to do this. But I like to write. At that point, I kind of felt like I understood what was going on in Distressed. And frankly, somebody came to me. It wasn't my idea. It was I really got cold called by my publisher and say, hey, we've done a survey of literature in this, and there doesn't seem to be any really good resource on distressed debt. And we've looked around, and you're always the lead speaker at all these conferences on distressed debt. And I happen to be the CFA official distressed speaker for if CFA societies wanted. So I had kind of a profile on distress, and they came to me and said, would you write a book? And I said, well, if I write the book, will you publish it? And they said, yes, if you write the book, we will publish it. And I said, oh, okay, well, as long as I know there's no downside, that it'll at least get done. I took on the challenge, and I'll probably shouldn't share this, so I'm oversharing, but How do you motivate yourself to do this thing? Well, I happen to like a glass of wine every now and then. And in 2004, I took a pledge on January 1st that I would not have another glass of wine until I had a complete draft of the book done.
And how long?
I had my first glass of wine on my birthday, November 22nd.
Wow.
Wow.
Same year.
Same year.
Wow.
Yeah, I had a very boring year that year. I mean, I was working my tail off at Imperial. I would often stay several hours late at night, kind of doing my research. So every week I had a goal of what I was going to write the following weekend, a chapter or a portion of a chapter. And so I'd have to do a lot of research associated with that. And then on weekends, I was kind of chained to my desk at my house, writing those chapters. And I kind of motivated myself by, I had an outline of the book and I tried to get chapters done. And then, my style is to kind of write quickly and get everything down on paper and then go back and edit it and make it good and add to it, and things like that. But it was a pretty boring year.
That makes sense. Wow. So did other people in Imperial Capital knew like you were writing the book?
Yeah, I didn't broadcast it, but
Right.
it was known that I was writing the book. And like I say, they certainly didn't cut me any slack in my responsibilities as head of the research department. So I was doing my job.
Busy year. So one thing I noticed in your book is that there were a lot of chess notations and game moves that was described in the book to aid the explanation of distress debt. So let's start off with, when did you start playing chess, and do you enjoy playing chess? And do you still play chess now?
I've been playing chess a long time. I forget exactly how I got introduced to it. It was not my father. It was a neighbor who, for some reason, took me under his wing and taught me the game, and I always just liked it. And then, I moved when I was in 5th grade, and I had been living in the Chicago area, and my father transferred and took a job in kind of the Des Moines, Iowa area. And I switched schools, and my 5th grade teacher just happened to like playing chess. And so we would play chess after school. And then I kind of fell out of playing chess for a while. I got to high school, and I decided to form a chess team. I heard that other high schools had chess teams. And so I just went to the president and said, hey, I think we ought to have a chess team. He said, well, yeah, I don't care. If you want to have a chess team, you have no budget. I'm not going to pay for you to go anywhere. But if you want to have a chess team,
Go ahead.
you can do it. And so I kind of started a little chess team there. And that's what kind of kept me engaged.
That makes sense. And can you describe more on like the relationship between playing chess and financial structuring?
Well, I wouldn't say there's a very tight correlation. What I was trying to get across was that distressed investing in a lot of ways is a multi-step game. You've got to understand that if you take one move, either another creditor or the debtor can make another move, and you had to anticipate what those were and know what you were going to do next. And so it was just kind of consistent with the old chess adage that you always have to think 3 moves ahead. And so that was the only thing I was trying to kind of reinforce with this idea of chess at the bottom of every chapter, was just, hey, always got to think 3 moves ahead.
Got it. Can I be honest with you? When I read your book, I did not know how to play chess. So it just got more confusing looking at the chess moves. But and then I started learning, and it makes more sense. But okay, cool.
And as I noted in the book, the way I picked the game was I picked out a very famous game between Fischer and Spassky from their World Championship game, and it was a game that had a remarkable turnaround right at the end, and so that was the game I picked to make the notations on.
Right. So since the publication of your book, we have the GFC, we have the COVID downturn, and a couple of similar distress events that were sector specific. Based on those events, is there anything else you would add or change to your book?
Well, I mean, hindsight's always 2020. That's out there, but as of the time it was written, it was, I think, pretty complete. Things have happened. Probably the most significant, in my mind, was the 2008 amendments to the bankruptcy code that among other things, reduced the period of what is called exclusivity, which is the time period in which the debtor is given the primary responsibility of negotiating a plan and coming forward with a plan to try and seek creditor approval of those there. Before that, bankruptcy cases could go on forever. And there were bankruptcy cases in various mass torts that had gone on for like 10 years. And people complained about that, and so they lobbied for a shortening of exclusivity to effectively 18 months. If you stated it, it's shorter periods that need to get renewed, and they typically are, but at 18 months, that stops, and all of a sudden the creditors can start proposing plans and things like that. And what that has done is basically force people to plan ahead, including companies, because they're worried that they're going to get into a situation, they can't get a plan, and then it goes over to the creditors, and particularly if you're the LBO equity sponsor, that significantly increases the risk that you lose your investment that's out there. So now when companies start to get in financial distress, the planning operation starts a lot earlier. All of a sudden the financial advisors identify who the major creditors are. They will go out to them. They will say, hey, I know you know XYZ is in trouble. They would like to sit down and discuss a way to, restructure things to keep everybody there. And so now, the number of plans that come in as totally completed, pre-planned Chapter 11s, which means that the major creditors have cut their deal as to what they're going to do. We've figured out how to finance the dip. We've probably structured the plan so that we don't have to have unsecured creditors vote on it, because that's a whole can of worms we don't need to get into. And they will come into a bankruptcy, file it, and say, Judge, the plan is being filed. The company is willing to come forward with a plan of reorganization. The creditors have signed something called a support agreement, saying that they will vote in favor of that agreement as long as the plan of reorganization is passed as proposed. And you can be in and out of bankruptcy in 3 months. And that planning process, which is just kind of front-loaded all the work. And things have happened in there. There are many people that argue that the way this has evolved, it is no longer really a full negotiation between all the creditor constituencies and the debtor when the company goes down, which is kind of what was initially envisioned in the bankruptcy code. And the practical reality now is it's basically just a handful of the major secured creditors get to control what's going to happen in the reorganization. And there are some people who think that that's not foil, but that's the reality is now.
Got it. Makes sense. So following up on that, in the topic of distressed credit market, to what extent has distressed credit market got more efficient? And are there examples of investment opportunities that you think may have existed 20 years ago, might not be existing today?
Well, I don't know about the latter, but the market has gotten much, much more efficient just because it has grown so much. When I was in it, I think there was only 1.6 trillion in high yield debt, in the leveraged loan industry was much, much smaller, less than $1 trillion. And now they're both over 2 trillion. So there's a lot more paper out there. There is, a plethora of dedicated distressed funds. I mean, literally when I got into the business at Drexel, well, even all the way to Imperial, even when I was at Imperial, I can only think of 3 solely distressed focused funds that were out there. And there was Oaktree, and then there were a couple of small firms in New York that frankly had like 115 AUM. I mean, it was nothing compared to what the industry is like now. And of course, as you have more players in the industry and larger debt issues that can trade more liquidly, market spreads start tightening up. And then there was also a regulatory requirement that forced broker the high yield debt market is an over-the-counter market. And basically there was a legislation passed around 2008 or 9. That was essentially when I decided to go over to the buy side. That required broker dealers to report pricing on trades to electronic distribution sites, so everybody would know the price that things trade up. Before that, nobody knew the prices. And when you had no price transparency, that allowed the broker-dealers to take pretty big margins on trades. And when they had to report all the pricing, then of course the spreads collapsed and made the market more efficient.
More transparency, more data. Got it. And then right now, also for the first time in decades, we find ourselves in rising interest rate, high interest rate environment. What are the implications in the world of leveraged finance?
Oh, well, a lot of expectations. I mean, there were a lot of deals that were done at a time frame where it was perceived that likely the Fed was going to go through a tightening cycle and take rates up. And so people knew that, and we were still doing all floating rate financing at that point. But there was also a pretty big expectation this is just going to be temporary. Rates are going to fall back down, so we don't have to think about the idea that SOFR, because remember in the aughts, like from 2010 to 2020, LIBOR was under 1%. And so when you talked about at the time LIBOR plus 400 loan, you were talking about a 5% loan, something like that. In fact, we were writing into debt agreements floors on LIBOR, so that, because people were starting to contemplate the idea of negative LIBOR, and that was kind of a mind-boggling concept to think about. So we wrote in floors, 1% LIBOR, there, plus the spread that was on there. And then when short rates started going up as a result of the Fed tightening, then everybody's interest expenses started going up. And again, when you're off that low a base, I mean, that meant interest expense was going up 50, maybe 75% above initial projection that was there. And if it's a highly leveraged deal, that materially impacts free cash flow when you have to pay all that interest. So it has caused a lot more companies to, get into financial distress, but the market has also evolved through this mechanism. We now euphemistically call a liability management exercise, where we, kind of consensually restructure the debt, recognizing that these firms can't pay these high rates. If it's a SOFR plus 5 loan, we're talking about 9% versus people who had an expectation that it'd be a 5% loan. They just can't pay the interest anymore. And so there's been a lot of work to work through those particular problems. But the high rate environment has definitely created a lot more stress in leveraged finance.
Awesome. Cindy and I obviously took your class, and I've been enjoying being a TA. But we wanted to ask, how's your experience been as a professor at USC? What's been so rewarding about it, especially after your successful career in the field?
Well, like I said, I kind of knew I always wanted to teach for the last chapter of my life. I don't know why I thought I wanted to teach necessarily. But the opportunity arose for me to start teaching at USC, and this is kind of the shortest professional commute of my career. I live very, very close to campus, so that worked out really nice. And I just kind of fell into this, what is my flagship course now, the venture capital and private equity class that's there.
And fixed income, of course.
Well, that wasn't the first one. I'll tell you the story on that. And I really enjoyed the VCP. There was a learning curve. I had done venture capital law, but that was 30 years ago. So there was a lot of learning I had to do to feel like I was competent to teach venture capital. The private equity side, that had been what I'd been doing, leveraged finance. So I kind of felt like I knew that side of the business well enough to teach. And then if you wanted to know about the fixed income thing, so the next course that they asked me to teach was valuation. And I did that for several years and enjoyed that. And then they came to me and said, hey, this is really working out well with the VCPE and the valuation, but we need somebody to teach fixed income. Do you think you could teach fixed income? And I said, well, finally, you're asking me to teach something I actually know something about. And then they said, well, wait a minute. Before you take this on, we should tell you that fixed income was the least popular class in the curriculum for the last 2 or 3 years it was offered. In fact, we didn't even offer it last year. We didn't think anybody would sign up. Wow. So just know you're excited going against those headwinds. And I said, yeah, I think I know how to teach this thing in a way that would make it engaging to students. And so I took up the challenge and I started teaching my fixed income course. And, I think it was pretty successful. And then they asked me to get involved and teach corporate finance in the online MBA program. And that just kind of sucked up my teaching load. And so I had to give up my fixed income class at that point because they wanted me to continue teaching the VCPE. And I had to give up the valuation course to teach all those other classes. But it was great and I have enjoyed it. I love working with great hardworking students like you and thinking I'm making a difference in your career. And I'm very pragmatic. I want to enhance your careers. I think I tell you that the first day of class, that my objective here is to help you get a better job.
Yeah.
And once you get that job, to be successful on the job. And that is the lens through which I view my teaching.
Yeah.
It's amazing.
It's amazing. And you also taught us we can cut this 50% passing.
Yeah. Awesome. The next, I guess, you've worked a lot with companies on the brink of collapse and have learned a lot about success and failure unfolding. What's maybe one surprising lesson that you've learned about leadership and resilience as you've seen that in the real world?
Well, I don't know if I've got a global, what have I learned about distressed leadership on that, but I will cite one case that particularly impressed me, and that was Adam Aron at AMC, the movie chain. And when the pandemic came, of course, nobody went to movies anymore. And AMC was fairly highly leveraged. Its debt traded way down. I mean, it had unsecured debt trading at under 10 cents on the dollar at one point. And it became a subject for one of my executive MBA class with another prof. And so that's what really got me looking at AMC. And their CEO, Adam Aron, just was a bulldog. He would not let that company fail. I mean, that thing should have been dead 20 times over. And he just would not say never. And so he kept fighting and fighting, put together the financing, took on some really onerous financings in the middle that were there, but he always found a way to get through. And then he was saved by the meme stock craze that AMC became a meme stock, traded up to 25, and he was able to sell equity at a decent valuation. And that's what created the cash that let him restructure the balance sheet. But I will never forget the tenacity of that guy. It was really amazing. So if there's any takeaway from that, it's, an individual with perseverance can make a difference for their company.
It's amazing. I guess moving forward, something that you mentioned in the first question was to build your own destiny. And I think I've learned that a lot in your class, further than just getting a job, but also making an impact and taking your own life into your own hands. What would you advise, students like ourselves at your age or at our age? And, how can we best equip ourselves to build that life?
Probably not going to like the answer to this. I actually think, in retrospect, and trust me, I was just as competitive and motivated as all of you guys. I kind of felt like, gee, if I don't get my JD MBA by the age of 24, I am, again, an abject failure in life. And so I rushed through everything and had to get that job and had to get to a certain title grade, et cetera, et cetera. But on reflection, one could have taken a lot more time and might have been better. I mean, it worked out fine for me, but I think it would be better for everybody if after high school or sometime during college, they took a year off and worked and really got to know themselves. Because I think way too many students, myself included, are very susceptible to just going with whatever the current trend is hot. I said in the beginning that I didn't know anything about investment banking, and then I got to Chicago, and you were worthless unless you became an investment banker, and I just kind of, okay, I guess I have to be an investment banker then, without ever really thinking about whether that was right for me or not. But take some time out to really get to know what turns you on, and I wouldn't worry. So everybody's so caught up, and I'm not saying it isn't important where you get that first job and things like that, but you guys are so talented, and there are a lot of opportunities in life, and you certainly can't predict what is going to happen that is out there. So get that first job, get some experience, and learn as much as you can, and do a great job. Always give more than expected. That's one of my mottos. Always give more than expected. And you should be recognized. I'm not saying it always happens, but you should be recognized and have the opportunity to grow. And what you're doing can be of second order importance. You're all very curious people that's out there. And I tell the story in my class. I got my first investment banking job at First Boston. And I was hired because I had some experience doing IPOs of something called savings and loans. And as soon as I got there, that market disappeared. There were a bunch of bad IPO offerings, and all of a sudden nobody wanted to buy IPOs of savings and loans that were out there. And we had to pivot to something called securitization. And I wouldn't have been able to spell securitization in an interview if I had been asked. That was there, but all of a sudden I had to learn securitization. And I had been a lawyer. I will tell you I was not particularly a numbers guy. I didn't know anything about an Excel spreadsheet back then. Well, of course, they were just coming into being. I hate to date myself, but yeah, all this stuff was just coming into existence as I started. And I got in the ground floor of securitization, and I found it fascinating. It was just really, really interesting. And I would still argue that securitization was probably the most profound financial evolution that happened in the 20th century. I mean, high yield bonds were important. Securitization was more important than that. And I got into it, and it was fun and intriguing. And I think I could have gotten into a lot of different areas. And I would have said, wow, I could have gotten into interest rate swaps. I had a really close friend who did interest rate swaps for First Boston. I thought, well, that's really interesting too. But so don't sweat what it is. If you apply yourself and get into it, you will probably find it pretty interesting. I'll give you another little anecdote that came up just last semester. So I had a student, and I kind of closed off the course, as both of you know, by having you do deal write-ups on private equity transactions to try and bring more real world into the course that was out there. And this student had worked at kind of a middle market buyout shop the summer before, and he wrote about the transaction that he'd worked on for most of his internship, and it turned out to be the roll-up of a heavy-duty tow truck company. These guys had thought there was a market to roll up heavy-duty tow truck companies, and this student had really gotten into that deal and found everything about the intricacies of the heavy-duty tow truck market fascinating, and shared them. And I'm really curious about business. One of the reasons I think I love being a high-yield analyst, particularly at smaller shops, when I was there, is that I had to be a generalist. And so every day I had no idea what I was going to be looking at. The desk would tell me, hey, the bonds of X are down 10 points, figure it out. And you'd have to go out and try and become an expert in a new industry there. And so if you have that curiosity, it's fascinating to go get to know different industries over time. So you just kind of get in, and with your level of curiosity and intelligence, you will find everything is actually interesting.
That makes a lot of sense. I'm going to close this off by mentioning another example you kind of mentioned in class about being grateful and then how to view success, not benchmarking by other people. I remember you were telling the story of walking your dog in a neighborhood. Do you want to share that?
Oh, it was just, when I looked at my peers at places like Drexel or at PIMCO, which was down in a very, posh Newport Beach there, as successful as they were, and we're talking about, the 10th of 1% in terms of just wealth, as successful as they were, they always felt like they weren't successful enough, that there was always somebody on their block who had a bigger house or a fancier car. And these were people who were making, 7 to 8 digit incomes. And I heard that from them. And by happenstance, when I had the budget to buy my first house, it was a very low budget. I think I was in my first year at Drexel at the time. And I ended up choosing a house that I did it on location. I ended up investing in something called the West Adams neighborhood, which used to be really, really nice houses at the turn of the century that unfortunately had fallen in decline. But the location is kind of equidistant between downtown and Century City, Beverly Hills. And I always thought as a finance guy, my jobs are always going to be in one of the other places. And, LA traffic, it made a lot of sense to me to kind of be equidistant. And one of the things I did not appreciate about the neighborhood was that it was a very diverse, socioeconomically stratified neighborhood. And every day I walked my dog and I would just, got to know all my neighbors. And, by some standards, I suppose financial standards, I was the most successful person in the neighborhood. But it was very grounding to have the experience of seeing all these other people that were out there and how fortunate I'd been. So that's kind of the story.
Got it. And thanks for sharing all of your experience and views on current events. We really appreciate your time.
No problem. This was
Thank
fun.
you.
Thank you very much for inviting me.
Thank you.